highly appreciated primary home, defer capital gains taxes using the deferred sales trust, while also finding ways to make the DST an investment, not an expense. That's a huge statement. I know. We're going to be breaking it down step by step so you can simply understand how this all works. And in fact, this is a live case study, so you're going to go along the journey with me. We're going to talk about adjusted basis. We're talking about maximizing cash out refis for tax-free dollars. And we're going to talk about how to use the DST to defer the rest of the capital gains tax and create a cash flow investment with the trust. And so here we go. Let's dive right into the screen share. And we're going to break down this deal. Okay, so understand that this particular property is a $7 million asset. First thing to understand. Number two, the debt on the property is zero. Debt is zero. The basis on the property is $4 million. Okay. Also, the fact pattern is this. The seller is a married couple. Okay. Seller is a married couple. Okay. And they are like a lot of folks that we work with here at Capital Gains Tax Solutions. They have lived in their house for decades, and they're looking at such a highly appreciated value of their house that they're feeling trapped by this capital gains tax. In fact, the difference between the basis and the sales price is about $3 million. And so in California, they're looking at about a $1 million capital gains tax. And so they have multiple kids. Their kids are now grown up and they have kids. And so they are looking at this big house. Their kids are gone, and they're saying, "Hey, how do I downsize without feeling trapped by this capital gains tax?" And you know, like most people, before they find us, it's challenging to find a flexible, diversified way to do this. That's been proven. And so we're going to walk through how this all works today. So sellers, married couple, and they live, the property for 30 plus years. Their kids are out of the house. And also too, another thing to keep in mind for this fact pattern is the fact that this particular couple has a lot of their net worth in this primary home. And in fact, maybe you feel this way. Maybe you feel like you're real estate rich and maybe cash flow light. Most of your wealth is tied to that one single home that you're living in that's not producing the cash flow that you would like. And you're shifting the wealth from more like a harvest of the wealth to plant it into assets that can produce cash flow. And by the way, if you're liking this video, I also want you to consider subscribing to the YouTube channel for more hands-on ways to do all of what I'm talking about to defer tax and grow your wealth. Okay, so back to the fact pattern. $7 million sales price, okay, is the price of the house. And then they have a zero debt on the house. They have a $4 million basis. Their kids are out of the house, 30 plus years in the house. It's a married couple, right? Also, remember, if you're in a primary home, it does not qualify for 1031. Does not qualify for 1031. So a 1031 exchange works for investment property, not for a primary home. And so the deferred sales trust, what we're going to show you here, works for all assets of any kind, including investment property, businesses, crypto, also primary homes, stock. And so they don't want to just sell and pay the tax. They also want to downsize, okay? They want to downsize and they want to buy a house that's a little bit smaller, a little bit closer to their grandkids and one of their sons. And so they want to downsize, but they don't necessarily need a $7 million house. They actually maybe only need about $2.5 million house, right? And they want to keep it all cash because they want to be able to stay out of debt. That's part of the thing they practiced. And so let's break down step by step what's the best way to do this. So number one, because they have no debt, they've set themselves up in a really great position because they have an opportunity to cash out refi up into the basis, right? In this scenario, the basis is about $4 million, okay? About $4 million. Always check with your CPA when it comes to this. Your basis, by the way, is determined by what you purchased the property for, plus the capital improvements. So for primary houses, If you bought it for, let's say, 3.2 million, and let's say you put in about $800,000 over the years in capital improvements, not just repairs and maintenance. Make sure you check with your CPA to get that correct number, and also make sure you have, you know, the documentation for the work that was done, so that you can justify all of that. And so once you have that basis established, and you have the difference, you have no debt, you can do a cash out refi. Now, here's the cool thing about cash out refis. They are tax-free. They are tax-free. There's no tax on a cash out refi, as long as when you go to sell the asset, the cash out, the debt that you've taken on the asset is not above your basis. So in this scenario, the sellers can cash out refi up to $4 million, because that is their basis. And so that's really important to understand. And it's a really neat way to grow wealth and to leverage what assets that are highly appreciated. And there's an opportunity to grow the wealth somewhere else. Okay, so let's dive right in step by step how to do this. Okay, so number one, what we're going to do is do a cash out refi. Cash out refi. Okay. Now, if you don't have a lot of cash flow to justify a traditional bank, you can work with other lenders that are going to charge you a higher interest rate, but you can get the cash out, and that's the key. And so in this scenario, we're going to cash out refi $4 million. Now, this $4 million is tax-free because it's not going above the basis. And so that's step number one. Now, the timing of this, I think it's important to understand that the timing of this, you want to do this prior to listing the property, right? You don't want to get, caught in a opportunity for a buyer to buy it and to lose momentum because you got to go cash out refi. So cash out refi before you list the property, right? In fact, this leads into step number two, which is, we'll put it right here. Step number two, which is set up the deferred sales trust. Set up the DST, okay? Set up the DST here at Capital Gains Tax Solutions. This is what we do. We help people every single day set up deferred sales trust, and then present an exit plan for them to invest the funds, to defer the tax, and to create cash flow and other investments, which is really great. So look at the deferred sales trust, understand how it works, and set up the DST. That's the next step. And now you have your position in a great place, because this is just optional, by the way. This DST right here is optional. You may or may not sell the asset right away, and you may end up, just wanting to pay the tax. It's totally up to you. But the key here is this particular client is trying to solve for this $1 million tax liability, right? It's approximately that. It's about 33% of about the $3 million gain. So you set up the DST. Step three, you list the property for sale, okay? List the property for sale. And you're also going to make sure that you're working with groups that have escrow in place, that have all of the details for how to work the deferred sales trust. This is what we do here at Capital Gains Tax Solutions. In fact, we worked and have sold collectively with our team and our strategic alliances over 10,000 transactions. And so we do this all the time. And so if you're working, we're happy to work with your agent as well. Just make sure they're working with us first, so we can make sure we can quarterback everything here. That being said, make sure that all of the people are ready to go. So you want to list the property for sale. You have escrow ready to go. You have the DST set up, and then you're going to get the property under contract. And when you get the property under contract, this is where you're going to simply have the DST fully vetted into the contract. So into the contract with DST. Okay. Now, when you're going to sell, that's step number 5. Sell, and this is where the debt is paid off by the buyer. Okay, let's walk through how that works. $7 million is the price. There's $4 million debt, which leaves approximately about $3 million. You still have to pay the closing costs to the broker who's selling it, but just to keep it simple, let's just keep it there. $3 million, which includes the $1 million of of tax liability. So what you end up with is about 4 million in your account, right? 4 million in your account already. And then 3 million goes into the DST. Now you had to carry debt for a period of time. Okay. So, that debt might be at 8 to 10%. If it's a quick cash out refi, it could be 6 to 8 if you can qualify, and you might have to carry it for 30 to 60 days, which is not ideal, right? But it's better than having all 7 million go into the deferred sales trust and then having to pay the fees on the 7 million, right? And so the goal would be to how to make the DST an investment, not an expense. And that's by lowering the AUM and getting cash out refi money beforehand, right? And so once the smoke settles and all the deals close, right? The debt's now paid off, right? You have 3 million approximately in the trust, of which you're 100% capital gains tax deferred at this point. And you also didn't get taxed on that 4 million that's in the bank, right? And that 4 million can be used to go buy your house. And let's say you're buying a house for $2.5 million, all cash. Great, that's all set. So you solve that challenge. You solve your capital gains tax challenge, and the funds are in the trust. They're invested. Stocks, bonds, mutual funds, they can be invested into real estate. They can be invested into lending to real estate. And really, it's just flexible what you can do with the deferred sales trust once the funds are there. And that's the beauty of this. You're solving your primary home challenge, which was, hey, how do I get the money out in a tax-free way, still be able to maybe purchase a primary home or be able to invest the funds kind of freely, and then maximize as well the capital gains tax deferral. And so the key is, again, understanding your adjusted basis, understanding the purchase price, understanding the debt situation, and of course, qualifying for the loan. So there's a number of moving parts. That's why we're here for you at Capital Gains Tax Solutions to help you build a capital gains tax exit plan. We have teams across the country to help list, sell the properties, and as well work with you to execute your particular fact pattern and goals that you're trying to do. And trying to accomplish. And so go to capitalgainstaxsolutions.com to get started. And as well, if you could like this video, that'd be amazing, because it's going to help the algorithm in YouTube to show this to more people. And feel free to subscribe to the YouTube channel for more valuable content like this. And check out the new book, Building a Capital Gains Tax Exit Plan. To learn more, you can go to Amazon to search that. Thank you so much for watching this video, and we look forward to connecting with you real soon. Bye now.